Everybody's expecting we get that quarter-point cut today, but I want to show some of the commentary from Fed officials in recent weeks and days. A lot of them sounding pretty hawkish. Even if we get that cut today, again, widely expected, about 95% of traders thinks we're going to get it. What are you expecting from the Jay Powell commentary, and what's going to be the impact on the markets?
Yeah, I think one thing is looking at cumulative inflation. I think that's one thing we focused on. If you're looking at cumulative inflation from 2021 to 2024, from the period of October to November, it didn't budge much, still around that 21 percentile range. So I think the one thing for investors to look at that, the Fed will be tracking, obviously, if there's any spikes in the data that they're tracking, obviously the CPI headline data and obviously unemployment. If we get any spikes in those data, then I think we'd potentially see the Fed make some sort of turn in their policy or some sort of turn in their strategy right now. But if we don't see that, I think they'll continue on this path. And I think 25 basis point cut, as you said, that we're potentially seeing would be a fair move for the Fed to make at this point.
All right. What do you think about the market reaction? I want to show you something. Bespoke, they put out some research looking at the market's performance on the day of a Fed decision under Jay Powell compared to other Fed chiefs. When you look at this, you're going to see a pretty stark difference between Jay Powell's days, the day of and also afterwards. You can see the last hour of the trading day after that Fed decision, a decline. Are you expecting a similar pattern to play out today? I mean, a lot of people believe we're going to get that quarter-point cut. That seems almost certain, but there's a lot of questions about, again, what's going to be said by Jay Powell after that.
I think the commentary is really important. That's what you're pointing out, is the commentary from the Fed is really important. The strategy going forward is really important. For me, I think the two risks that I'm seeing is any sudden movements or sudden triggers or spikes in our two data points, right? Like looking at unemployment, if that ever spikes, above 5%, and looking at CPI head inflation, if that ever starts to creep back up or get hotter again, those are two areas where you can see, obviously fluctuations of volatility in the market. So I think people can prepare themselves by keeping a track on that data and position themselves relative to what they potentially think could happen. And that's what I'm planning to do, and that's what we're planning to do for investors here.
Right. So let me ask you this. If we do get this hawkish cut that a lot of people are anticipating, where are you going to advise your clients to put money? I know you've been really growing your business and also kind of diversifying your client base, including some NFL players who are generally high net worth individuals. If we do get that hawkish cut that a lot of people think we're going to get, where are you advising clients to look for opportunities after that?
So I think there'll be a few obviously a few areas. For some younger clientele and for some other clientele that have high net worth, the thing that they're able to do is, one, have a lot more time, and two, have a different risk profile in some cases, right? And so a lot of them are looking at things like tech and things that have been doing really, really well over the past year as a potential bullish trend into 2025. So hawkish cut, or if the Fed potentially is more dovish, they're still looking for those opportunities, and that's where we're positioning them. And we like what's been going on now. We think that's still going to continue in 2025, barring any of these two risks we see to the bull market.
Can I ask you how you feel about bonds? I've seen a couple articles out saying that if you want to kind of take advantage of the bond yields where they're at right now, you should lock it in. But again, there's some questions about the rate cut path forward. Do you think right now is an attractive time to get into bonds, or potentially after the new administration takes over that a lot of people think may be inflationary and we could see bond yields spike then?
So we had those positions and locked in those positions, way in the past. And I think right now wouldn't be the best time for investors to just pile back into bonds. I mean, we're seeing different movements in the bond yields, as you mentioned earlier at the top of the show. We've been releasing some of the bonds, and it's because we're looking at more at equities and obviously the positions in equities, and we feel that that's a position that we want to be more heavily weighted to versus bonds at this time, because those positions in the bonds we were locked in, much prior, and our strategy has changed and shifted toward those equity positions.